Nick, very good to see you. Money market funds, the hottest investment that may end up costing you. Following several rate hikes by the Fed, money market funds are earning about 5% or more right now. They're so attractive, investors are holding a near record $5.6 trillion in money market funds right now. Well, these are seen as
Jeez.
pretty safe investments. I know, right? I want to ask you about the opportunity cost of putting this much money in cash.
Well, the problem with these money market accounts, they're granted they're paying wonderfully right now. People look at it as safe, and I think a lot of the reason why people are pouring into this is because of that. They want the safety. It's what we call the flight to safety, because people have been seeing what's going on. They've been hearing about the potential recession for the last couple years, and so consumer confidence is down. The Fed hiked up interest rates to where now, instead of getting a bottle of water as your interest on a money market account, they're actually paying something decent. Well, so what's happening is people are thinking this must be the new wave of the future. I found the perfect investment, no risk, 5%. This baby is going to be here for forever. And that's not going to happen. The fact is, the Fed hiked up these rates. That's why money markets are higher, but it's a short-term picture. So it's causing people to get very myopic with their investing strategies. They're focusing on the short term instead of the long term. They're thinking about rates that aren't going to stay at this level forever, because they're going to change. So instead of looking at ways to lock these rates in for longer, people are tying their money, or not tying their money up, but they're moving into these things that are just very short-term good rates, but not long-term.
Right. So when choosing though how much of my portfolio to allocate to cash, should my first question be what's my time horizon?
Yeah, so time horizon is definitely going to be very, very important. So if we think about buckets of money, near term, midterm, and long term, and I'll wrap all this around, because what's happening when we look at money market accounts is money market accounts can change the rate by the week. So it's not like a 1 year rate. It's a 1 week rate, and I've seen some that change almost all the time. Uh, Granted, it's been higher, but that again, we're going to start seeing next year where it's either going to stay there or start trickling down. And then people are going to wonder, well, now what do I do? Well, here's what you can do to be proactive is lock in these rates now. So instead of using a money market account that pays 5% for, right now, or maybe an investment that's only 5% for 6 months, I would be looking at what investments are out there that I can tap into that will give me 5%, but lock it in for maybe 5 years.
Hmm.
And then that way I actually have money that's earning these rates for a longer period of time. And so wrapping that all together, if I was looking at three buckets here, we'll call bucket number one your near-term bucket, or the now money. This is the money that you need for the next 0 to 3 years. And the next bucket we'll call the midterm bucket. We'll call this one your soon money. You don't need it now, but you need it soon. 3 to 9 years. That's where this is going to take care of it for me. That's what's in this bucket. And then we got our long-term bucket. That's the later money. I don't need this for a while, 10 years or longer. So if you look at this 3 bucket approach, in the near-term bucket, this is your low to no risk. A money market account might fit that because you need that money liquid. In that midterm bucket, this is conservative stuff, something that's going to have that higher rate maybe for longer. And then you have your long-term bucket that could be like the stock market, the stuff that you can leave sit for a while and you can let it ebb and flow. And over time, it should keep up with inflation and help outperform inflation. But that's going to be your moderate growth bucket. You just don't, you want to have the right amount of money in each bucket. What's happened is people are taking all the money out of the long-term bucket, all the money out of here, and they're dumping it into this near-term bucket because the rates are higher. But then the thing is, when I'm asking people, well, when will you know to take it out of here and put it back? And they're saying, I don't know. These rates should be good for a while, right? Yeah, until next week. So because they could change the rates just as quickly as they do that. So what you don't want to do is you don't want to have money that's earmarked for long term, that's actually in the short term, near term bucket. And you don't want to have money that's here and maybe a program that's paying you 5% for 5 years in this bucket when you might need this money in 2 years, because then you got to surrender money to get it back over here. So you just got to have the right amount in the right buckets, what I call optimizing where your money is actually invested in the short term, the near term, I guess you could call it the now, the soon, and the later money.
Hmm. Right. A lot of us are being a little bit short-sighted, and here's why. You've said before that the best way to invest is to build a well-diversified portfolio. It will preserve purchasing power over time. It's often your best hedge against inflation as well. Take a look at this visual, Nick, and this kind of puts it all in perspective.
It does. I mean, so the thing is that we look at these, here's almost like you could call this three pots, just like I was talking
Yeah.
about, the three buckets. The problem with being very short-sighted is to bring this around on what that actually means, that would be like playing a football game and you just have a quarterback sneak. That's the only play that you know. And in the beginning, maybe it really works and you keep running that play, but it's only a matter of time before the other team figures out what you're doing. And then you can't run that play anymore. And then you've got to have other things going on. That's what we call diversification. When the short game doesn't work, you got to have the long bomb. And so what that chart that you just brought up, that's kind of what I'm talking about here. Is granted, right now, if we look, you have the top line, which is your federal money market account, your money markets. They're paying a little bit better right now. Then you got your bonds, and then you got your S&P 500. How I look at this is the bottom is like your equities. That's like your long game, your long-term money. The middle, that's like your middle bucket. That could be bonds. It could be bond alternatives like structured notes, or it could be like annuities. Principal protected annuities could fit in there too. There's other things too, but that kind of shows you that middle. And then obviously the top one there, you have your money market accounts. So you diversify because you just never know, when is that money market account not going to pay me as good as it is today? And if I had everything in that one pot, I might get in trouble. But if I have it diversified across these other buckets, when this one isn't doing so good, maybe that one does better. And it's the blending of them all.
Mm-hmm.
That's what actually helps. And so again, you don't want to just have a quarterback sneak. You want a portfolio that has run plays, pass plays, all sorts of things diversified, so that when one starts to not work, the other ones can catch up and help the overall picture to be better.
Right. When your quarterback gets injured, because that happens.
It happens more and more. I'm from Cincinnati. And so when all the news came out about Joe Burrow being the #1 highest paid guy like ever, and then I think it's like 2 games later, he gets injured and he's out for the season. So
he was such a good kid too. I really like Joe Burrow.
Hey, he likes style, I mean, he's definitely style. I think he came from LSU. And so,
he did.
But he's brought a lot. I mean, that team, if you think about the Bengals, I mean, I was back in 1988. The Bengals were definitely like the team, it was Boomer Esiason. Bengals went to the Super Bowl. And then we had absolutely nothing to say between 1988 and like a couple years ago.
Right. Joe Burrow's another good Ohio boy, though. Like you, I think he's from Akron, isn't he?
I don't know exactly where he's from. Wherever he is, I hope he gets better soon, because
you owe me a Coke. He's from Akron, okay? Hey,
really
Nick, how do people get a hold of you with questions so that they can properly diversify and make sure that they are optimizing their money as opposed to just letting it wither away in these money markets?
Well, it's always going to be the best to give us a call at 844-GROUP-10, and what you can do is to set up a 15-minute strategy session call with us. But we have tons of other content out there, our YouTube channel, our Facebook page, we have Instagram, all that. There's so much content, and you can find all that content by just going to our website, group10financial.com, and you'll see all the access to all that high content, because you really got to get coached up on this, because next year is going to be a very weird year for the markets. We're heading into an election year. That always makes things very weird. The Fed is going to be making some changes. That's going to make things weird. And you got to be ready for it, for whatever happens and whatever we get thrown.
Well said. All right, Nick, thank you.
Great being with you, Erin.